there are medium-term targets, and then there are targets for 2020. For the medium-term targets, overall GDP growth to average 5.7% for the period, non-oil to grow at 5.9% for the period. Then inflation to be within the target band of 8 plus or minus 2%. Overall deficit to remain within the Fiscal Responsibility Act threshold of not more than 5% of GDP. Then the primary balance to be in surplus, and then gross international reserves to cover 3.5 months of import of goods and services. For 2020 fiscal year, the macroeconomic targets are as follows. Overall real GDP growth of 6.8%, non-oil real GDP growth of 6.7%, end of period inflation of 8%, fiscal deficit of 4.7% of GDP, primary surplus of 0.0% of GDP, and then gross international reserves to cover not less than 3.5 months of import cover. Now we see attempts to grow the non-oil sector, a target of 6.7%. And the question we ask is this an attempt to diversify the economy so that we don't over-rely on oil? Because it looks like oil output is likely to decline in the coming years. And so we need to diversify. Otherwise, we would be like Nigeria, where in 2016 they recorded stagnation because oil prices tumbled, and that is not good for an economy. So I'll then move swiftly to the key areas. So first, the fiscal sector. The overall fiscal target for 2019 was a primary surplus of 0.1% of GDP and an overall deficit of 4.5% of GDP. As I mentioned, the outturn for the period from January to September was about 0.3%, that's the deficit, and 4.5% deficit for primary and overall balance, respectively. Indeed, the target for the overall deficit for the period ending 2019 was 4.1% of GDP, suggesting that a worsening of the fiscal position had been recorded. But the target was 4.91%, and we recorded 4.5%. This provisional outcome suggests that the overall deficit target for 2019 will not be attained. The 2019 target will be difficult to meet, even though we still expect the target of 5% of GDP as prescribed by the Fiscal Responsibility Act. The worsening fiscal outcomes in 2019 is largely on account of shortfall in revenue targets. Revenue to GDP ratio was 10.5%, extremely low, compared to a target of 12.1% for the period ending September 2019. Indeed, this was lower than the 11% recorded for the same period in 2018. So you see our revenue situation worsening since 2018. This in turn is driven by a shortfall in non-oil tax revenue. The lower than expected revenue realized has been associated with a lower than programmed government spending. Government expenditure ratio as of September 2019 was 15%, as opposed to 16.2%. So you see a cut in spending to match the revenue, cut your coat according to your size. Unfortunately, and I think I saw a cartoon where Issa was with a tape measure trying to measure the president to cut his coat according to his size. So very, I don't know how these media people do their own thing. I think it was Dr. Aka who was doing the measurement. So we have revenue underperformance compromising fiscal and growth prospects of the economy, because every time there's a cut, it is a capital expenditure component that is cut. And we'll see that shortly. The overall deficit is projected to be 4.7% in 2020, with primary surplus of 0.7%. This will be on account of relatively higher growth revenue related to expenditure. Should these revenue and expenditure targets be met, the fiscal outcome will indeed be commendable. Now, there are a few things I need to highlight under the fiscal. One is, you realize in 2020, the projection is that wages and salaries and interest payments would account for 27.12% and 25.9% of total spending. So if we are going to spend 25.9% on interest payment, not on the capital, not on the principal. After the principal, we are keeping it for posterity. When they come, they will pay. But we pay very little of it. But the interest component, 25.9% of total spending goes into that. And then when you add 27.12% as wages and salaries, we are left with very little to do other things in terms of development. There is no doubt that tax exemptions, higher interest payments, and revenue shortfalls will continue to pose challenges in 2020, thereby affecting capital spending and stifling growth. The fiscal deficit target of 4.7% of GDP is unlikely to be achieved. It is unlikely to be achieved. And I add that it is economically prudent target. It's an economically prudent target, but politically unappealing in an election year. In an election year, if you achieve 4.7% of GDP, prudent, smart. But in an election year, that would be unappealing because there will be a lot of wage demands, there will be a lot of demand for roads, and I believe you see this. No road, no vote. No electricity, no vote. No water, no vote. I mean, all these demands, these pressures will come. And if you were in the seat and there is a strong opposition and you want to achieve a 4.7% fiscal deficit, that is why we say it is politically unappealing, and we think there is likely to be a deviation from this target. In terms of let me now move on to the monetary sector. The target is to ensure price stability within an end of period inflation, with an end of period inflation of 8%. Gross international reserves for 3.5% of import cover. Core inflation, it was 6.3% in September 2019. We expect to forecast of 8% inflation in 2020, and which is close to the medium-term target of 8 plus or minus 2%, barring any unforeseen shocks. But can this be achieved in an election year? I think we leave ourselves with that question, whether we can achieve an inflation rate of 8% in an election year, a single-digit inflation in an election year, because we all know the pressures that will come. Everybody would ask for market premium, the cleaner, everybody wants market premium. Yeah. And then money supply was slower in 2019 and is likely to also decline in 2020. The Ghana reference rate, which serves as a base, remained flat in 2019 and less likely to decline by a significant margin in 2020. The exchange rate cumulatively to the dollar cumulatively was 9.22% as of September 2019 and likely to depreciate much higher in the first quarter of 2020 because that's when companies repatriate their profits. That is when we pay for some of the Christmas shopping. So between now and the first quarter, you see some movement in the exchange rate. And if we don't have enough reserves, it can be very troubling, particularly for the private sector. The GSC Composite Index declined in 2019, but we are told that there are prospects for 2020 in view of expected improvement in financial sector uncertainties. Now the cleanup has been completed, so we're likely to see improvement in on the Ghana Stock Exchange. In 2020, favorable global financing conditions are expected while domestic credit is expected to be strong. The recapitalization exercise would continue to promote sound financial indicators with expected expansion in mobile money and credit without increasing interest rates. Expected developments in the real sector would also propel growth in net domestic assets and net foreign assets. Financial sector growth has been minimal, as I mentioned earlier, it's about 1.8%. However, total deposits increase while capital adequacy ratios remain high. Reforms of special deposit institutions, the introduction of deposit protection insurance in December 2019, in addition to effective regulation, including good corporate governance structures, would ensure a more stable financial sector. Ladies and gentlemen, in 2020, outlook risk of government crowding out the private sector and excessive pressure on the interest rate has been noted, because government is borrowing quite a lot from the domestic system, and that will crowd out the private sector. Also, increasing debt stock and debt sustainability remains of great concern. Concerns about taxing mobile money remains and can affect financial deepening, especially the poor who have no access to formal banking services, especially with the collapse of microfinance and other non-bank financial institutions. There are many people who feel very intimidated to even enter the banks, and mobile money is convenient, very useful. So if we want to zoom in and tax, we ought to be very careful the way we approach it. It will be a gradual step, but if you are not careful in impose higher taxes, that can affect the mobile money sector. Ladies and gentlemen, in terms of the external sector, Ghana's trade with the rest of the world is growing, especially in recent times. However, this trade has mainly been driven by exploitation and export of primary products, mainly natural resources. Primary commodities have continued to dominate Ghana's export, and export destinations are still concentrated largely in industrial countries, including the EU. If you look at the top 10 import sources, you will find China. But if you pick our top 10 export destinations, you might not find China. So it looks like we are still bent on the traditional areas, exporting in raw forms, and we need to diversify. Moreover, the dependence on primary commodities subjects exports to the vagaries of the volatile world market, exposing those countries dependent on a narrow range of primary commodities to serious balance of payment problems, especially if these commodities face declining terms of trade. So far, trade has not had the desired effects on employment, income, and human development. It has not translated into sufficient, decent jobs. There is an urgent need to diversify Ghana's economy towards higher productivity activities in manufacturing. Industrial output and manufactured exports still account for negligible shares of total output and exports. The challenge facing Ghana, as with many African countries, is to transform the economy from a resource-dependent one to a dynamic, diversified industrial economy.